We are joined by Larry Kallevig, who is the owner of Haven Financial Group. We actually welcome him back to the conversation here on WCCO. Good evening.
Good evening, Moose.
So we're talking about some changes that have occurred to how your credit score is evaluated, and it looks like this is going to be a good thing for consumers, huh?
It's going to be a good thing for a lot of consumers. Certainly it won't affect everybody, but it's starting right as we speak here in July.
And what exactly is being affected here?
There's numerous things that are not going to show up on people's credit reports that always have, that were a detriment to getting credit, if you will, such as things like tax liens, certain tax liens, judgments, monetary amounts awarded by a court, medical debts. That also is going to be taken out of the equation as far as being reported to those credit bureaus. So a major change coming down the pipe.
Yeah. I think medical debts are probably the number one thing that ding people's credit scores, and they don't realize it until they go to apply for a mortgage that, they might have some unpaid doctor bill out there from 4 or 5 years ago.
Yeah, what we found is that the medical debt, these companies, they've been reporting this before the insurance companies have even had a chance to pay, and you're right. When do you find it out? Only when you go apply for something, and then you're bewildered that there's a problem.
Wow. But is this really a good thing? I mean, when you're looking at somebody's ability to repay on a mortgage or a debt or whatever, I would think you'd want to know all the things that are kind of eating at their monthly budget, wouldn't you?
Well, certainly we can go back in time and say when their credit got lax and it caused problems. The good side, people could say, well, there was lots of inconsistencies in public reporting, names being messed up, no social security numbers. Inconsistency is really what lends to this change. Now, the flip side is you relax credit, you give it to people, higher default, and they're going to be forced to raise rates.
Yeah, because I've seen this movie before. I know how it ends, and I kind of see this as a little bit of a drip. We're starting to loosen up the credit lending, evaluation system. And then what's going to happen is, we're going to have these lenders that are going to come crying all poor mouth. We had all these people that couldn't pay us back. And it's like, well, wait a minute. Does the general public know that you spent hundreds of millions of dollars lobbying Congress to get that stuff taken away? And now you're bitching and screaming because you got screwed by what you wanted? Sorry.
No,
I got up on my soapbox there. Yeah, I when I look at this kind of thing, I'm a little leery.
With good reason. I mean, Vantage Score, there's two major scores, as we're well aware of. Vantage Score, which is a new one, they'd always pull your credit. Well, that's changed dramatically. In fact, they're using what's called trended data, not the snapshot of when you pull it, but what your patterns have been paying back, monthly payments and so forth. So, big purchases have had drastic effect. Not so much now because of the different ways that they've changed the formula.
Yeah, that's the Vantage Score. Again, I don't know if that's it's great if you want to get more people into the pool, so to speak, to be able to qualify to borrow money, but I think we're lowering the bar here.
Yeah, most would argue that we definitely are, and as you said it very well, we've been through this before. Now, what does that all mean? We don't have a crystal ball, but at the same time, you're widening the pool.
So as you look at trying to shore up somebody's credit score and all of that, what do you recommend with regard to, like, if somebody has a bunch of old credit cards, should they immediately go and cancel those out?
Well, it's always been preached that, if you have a bunch of different credit lines, credit cards, don't close them because that's going to adversely affect it's going to ding your credit because that's the way it's been. Well, with this change, not so. In fact, it's being encouraged now and recommended highly that you do close out any ones that you're not using, minimize the amount of credit that you have, and certainly don't take advantage of all those credit card offers and all those things that people come, because those prime credit people that have prime scores that have taken advantage and have all that credit, it's going to negatively impact them now.
Sure. And when you've got a bunch of this stuff hanging out there in this day and age of identity theft, what's to say that somebody couldn't find, an open credit card that might have a $3,000-$4,000 limit on it? You never use it, but if they can get in there and change, the mailing address or the banking information of where that, that money could be borrowed against that account sent to, you could get ripped off there.
Yeah, you're opening yourself up big time by doing that.
But I didn't realize that closing these accounts now, you can do that and not ding your report or your score. Because, I've always heard that you wanted to leave them open and don't mess with them.
That's been the rule of thumb, and that is the opposite today. We've been taught that all the time. This new formula, close them. Don't open up new ones unless you absolutely have to. The more credit you have in this formula, the more it can possibly ding you, because they look at it as the possibility of racking up debt in a hurry.
Sure. And you recommend, if somebody's got a bunch of credit cards and credit card bills and big piles of debt there, pay it off in the snowball effect way?
Yeah, it's like, pay your bills on time, of course, making monthly payments. But if you are those that have the credit card thing, the snowball effect, pick the lowest balance one, pay it off, pay the minimums on the others, pay that off, build momentum, go on to the next one. And by doing that, it's certainly going to help your credit score dramatically.
Sure. Would you also want to factor in maybe which ones have the highest interest built into them on the revolving charge?
That's certainly going to be a factor. That would be right towards the top.
Yeah, no kidding. Because it's like every week I get, letters from various credit card operators, where you could borrow $10,000 or whatever, and you have 18 months to pay it off. And if you read the fine print, man, you're looking at, like, in some cases, I think it's 20-some% interest after 18 months. And if you don't pay it off in that 18 months, the interest doesn't start at that point. It goes back from day one.
Yeah, they really get you on the interest. They can really take advantage of you. But if you're a deadbeat credit card holder, of course, they don't like that. But at the same time, with this new formula, I encourage, if you're not using them, close them. People took that at the advantage with all the rewards and the sweet deals. If you did pay them off, you could use that to your benefit. But if you're not using it with this formula, get rid of them.
Sure. Well, and I think, would you say that most Americans today probably pay the majority of their weekly finances, grocery, gas bill at the gas station? That's all electronic. It's all credit card payment anymore, isn't it?
Yeah, we see it on a daily basis. Our company deals with those that are 55 and above mostly, and primarily that is the case. Rack it up on the card, pay it off. We see that most often. Today we're in the electronic world, no doubt about it.
Sure. I find that interesting because with your company, Haven Financial Group, I would think that for more older Americans, they still like the idea of just paying cash. I look at my parents and they're just not big credit card monthly, spenders, where my wife and I, we charge everything, but we pay off our charge card every single month.
Yeah, I don't know what that age exactly is, but there's a distinct age where that is true, and then there's a distinct age where all of a sudden they have gone more to the electronic and the credit card. Either way is effective, but of course, being disciplined at the same time, that's the most important.
If I had to guess, I'd say that baby boomers have no problem with the credit cards, and paying everything every month or with a credit card and trying to pay that off every month. I think it's their parents' demographic. That
would be an accurate assessment, no doubt about it. That would be very accurate.
For sure. So are we, from your standpoint, as you guys at the Haven Financial Group, I'm sure follow where we are in this economy, it seems like, when I look at the stock market, good Lord, the tech stocks, everything, that just seems to be still on fire. And I thought I saw today where we're right above or right at where we were with the tech stocks just before the .com crash.
Yes, that's completely accurate. The market's very, very, very high, and quite frankly, that's great. With the group that we work with, though, we always encourage how long will it stay there. We nor anybody else has a crystal ball, so we all know what happens. So be balanced and make sure you're disciplined in how you're managing those investments.
Sure. And if you have questions, you can give Larry a call, Haven Financial Group. Interesting to see that this change could be good, but maybe we'll be talking in a year or two about how this was the beginning of yet another cycle where we allowed a bunch of people into the party that really shouldn't have been there borrowing money. Wow. Interesting. Larry, always a pleasure. Thanks for joining us.
Thanks, Moose.
That's Larry Kallevig joining us here on WCCO. He's the owner of Haven Financial Group.